You can think of the very first day discussions in the economic system, how an economic system works. In that, we saw several markets. Can anybody explain what are the markets we discussed within that? You bring those. I always told, like I always telling you all, like, okay, keep a mind mapping. Now it's a time to bring back, retrieve those information. Now always keep that simple picture on your mind. Now tell me, what are the markets? Not only Chaturanga, anybody can tell me. Oh, what are the markets we discussed there? We draw a picture saying this is the flow of economic system, maybe income flow of economic system, right?
Basically, we discussed about the production factors.
Yes.
And how it is being provided by the households, and how the business firms give it back to by way of a payment to households. So basically, we discussed that market.
What market you are referring now? Space. Your understanding is correct.
Closed economic market system. The closed economic system.
True, we discuss only a closed, very basic economic system, but there we discuss
product markets and resource markets.
Again, Dilshani.
Product market and resource market.
What is the first one?
Product market.
Yes, you are there almost, right? Anything else? Okay, the specific name for that one is like, okay, the firms selling goods and services to household. That's a goods market, right? We call it good market, right? So one is good market, right? Second, the household giving production factors to firms. That is, we call it what? Factor markets, right? Even labor markets included into that. We say always factor markets, right? And then in detail, one more, when you pay or when you pass your serving into firms as an investment, that's a financial market altogether. Three important markets we discussed there, right? One is factor markets, right? Second is goods and services market. And third is specifically financial markets. We discussed, right? Okay, here the basic question, what I'm asking is, how do we determine a price? As Chaturanga said, yes, of course, if other factors are constant, can you all hear me? I think there's an interruption.
Now we can hear you now.
Yes, yes. Thank you. So then now we were talking about the determination of price. In that we agreed, okay, the price is determined by the demand and supply. Which market we are talking about?
Financial market.
we are talking about sugar, right? So selling sugar, the demand and supply with regard to what? Is it regard to sugar or not? Yes, or something else, right? Come on, which market?
Product market.
market.
Exactly, we are talking about goods and services market. We are like, you are going to, right, sell your goods, right? So then what is mean by the market? It's like, okay, the place where the buyers and sellers meet, right? So it's a basic definition. Now it's anyway the virtually also, like you can call it, there may not be any place, but always buyers and sellers are meeting, right? So that is we call market. And when we say goods market, so then you are going to change goods. Here, like you are going to sell sugar. So it's a good market we are talking about. In a good market, prices are determined based on the demand and supply. That we have done in our high school economics. So everybody knows, okay, always that's also one of the like basic concept we can never forget, right? So always we have to think about. Here, we are not talking about the price. We are talking about the interest rate, right? So now I always used to have an example for better understanding, even though there are differences, right? What is the banking business? If anybody can tell me in a very layman language, what is banking business?
Channeling funds from deficit from surplus unit to deficit units.
Correct. It's an academic answer, right? I'm asking you. You're right. Perfectly correct, right? In exam perspective, yes, that's the case. I'm asking in a layman language, in a very simple way. How do you say if you are going to say this one to somebody who is standing at the bus halt, he may not be understanding this one. Anybody else? Okay, in layman language, we can say the banking business is a buying and selling of money. In a good market, you buy and sell goods, right, for a price, right? Here, you will be buying and selling, or bank, if you take like bank, they will buy money at lower rate of interest and then sell money, right, at a high rate. In a goods market, we call it price. In a financial market, we call it interest rate, right? There are a few differences you could see, but in the sense, like one example maybe, okay, in a good markets, if you sell outright, that's it. You don't get the good again, but here you will get the capital again with the interest, right? It's something different. Okay, leave it out for a while. So it's in a goods market, we call it price. In a financial market, we call it interest rate. So now our question is, how do we determine interest rate? Right? There are a few theories around that, right? So first, right, we could see, right, the interest could be determined by financial assets, right? That's the first thing, right? Okay, now let's say before understanding that concept, we have to think about, okay, now you just change your mind from goods market to a financial markets. If you talk about a financial market, right, what are the items sold in a financial market? Anybody, if you can tell me? Or what are the instruments you sold? Financial markets, it's always okay. If you are confused, I will just explain that. In a financial market, in a good markets, goods are sold. In a financial markets, financial instruments are sold. Right? So buyers of financial instruments and sellers of financial instruments meet and exchange. Can you tell me one example for a financial market?
Capital market, money market.
Yeah.
You need like the specific examples.
Yes.
Something like treasury bills, treasury bonds.
Of course. Yes. So treasury bill, bond market, government securities market, we can say, okay, or very simple and forward, maybe a Colombo Stock Exchange, right? So that is a market. You buy and sell financial instruments. And as you said, okay, government securities market, you buy and sell securities. All right. So this is a financial market, right? Okay. In that market, right, you have the financial instruments. Let's assume a treasury bill for a sake of having treasury bills. Now, first of all, we have to understand before coming into an interest rate determination or equilibrium, we should understand, okay, what are the factors that influence the demand for financial assets. So our next topic would be determinants of asset demand. When I say asset, I'm just referring to financial assets. Okay, can you all just list out to me what are the factors, right, that determines your demand for financial assets? Can anyone tell me? Just to
Return that we get for each finance, let's say maybe interest rate or maybe the coupon rate, maybe the dividend that we get.
Exactly. So one is, you see, now you practically you can think of, or like you can put in a theoretical form as well. You take the economic system, right? We know, okay, there are households and firms, right? Now household has excess money now. They want to park that money or invest on financial assets. They have variety of options, right? They can go for treasury bills, they can go for treasury bonds, okay, they can go for share market. They have variety of option, even the corporate bonds, right? So you can have, as a household, you can have different kinds of financial assets, right? So the question will come, which assets you are going to have it. It's basically based on different factors, whether to buy and hold for. It's an alternative scenario. You have treasury bills and treasury bond and shares and corporate bonds. So these are financial assets, like you can, decide alternative, right? Okay, now the question is, okay, how do you decide? So as Chatran said, one is expected return. What does that mean? The return expected over the next period on one asset relative to alternative assets. You should be very clear. Okay, you should be able to compare, right? If there's nothing to compare, no option to you. So here, expected return, one is expected return. You are going to compare the expected return with various financial instruments. That's one. The next, if anybody can tell me. Come on, just we have to make a discussion session. Sometimes it may be like, okay, very basic questions. So, but let's discuss. What else? Here now we are discussing what are the determinants of an asset demand, right?
Disposable income or whatever the savings that each person has, especially when it comes to demand side.
Definitely. Now, yeah, this is the way like we have to think actually. Like you can think of, okay, households, right? So if they are like disposable income or like their savings is more, then they will try to invest more, right? So that we can call it wealth, right? It's an accumulation of savings or resources, right? So if an individual have more resources or more wealth, they will make more demand to the financial instruments assets. So one is expected return. If you think like you will get a more return, you will increase your demand. If you have more wealth, you will increase the demand, right? Anything else? The next one. What else?
Realizability.
Yes, Rangana, I couldn't hear you.
Realizability.
What do you mean by realizability? Okay, I think you are talking about the risk there, right? Maybe default risk. Okay, whether we can get the money back, right? Something like that. Yes. So that is a risk factor. The degree of uncertainty associated with the return on one asset related to alternative assets. So we call it risk, right? So whether we are going to invest on corporate bond or whether we are going to invest on treasury bills, we just analyze the risk factor. So other one is risk. Okay. Oh, I don't know. Rangana may be talking about the liquidity as well, right? Whether we can convert easily, right? So if you want to convert your investment as soon as possible now, like you don't want to have a cash, so you are going to invest on a financial instruments. So that should be, like should be able to solve immediately or as and when needed, so without any time lagging or like with no loss or less loss, right? So okay, I think you have answered many important aspect of this determination. One is wealth, other one is expected return, and third is risk, and fourth is liquidity. Now, as an individual, if you have more wealth, you will make more demand. If you think your expected return is higher, you will have more demand. And if you think the risk is high, then you will have the demand less compared to other financial assets. Or if you think, okay, it's a high liquid one, then you can have more, right? Okay, so and demand of an assets depends on these four variables primarily. Is that okay? Right. Now, as we discussed, this is what theory of portfolio choice says. All the determining factors we have just discussed can be assembled into the theory of portfolio choice, which tell us how much of an asset people want to hold in their portfolio, right? So always the portfolio choice theory says holding other factors constant, as I said earlier, the quantity demanded of an asset is positively related to wealth. right? Positive. The first factors are the demand of an asset and the wealth. These are the first relationship is between these two, that is positive. When the wealth goes up, your demand goes up. When the wealth comes down, demand comes down. Right? Okay, that's first one. And second, the quantity demanded for an asset is positively related to its expected return relative to alternative assets. So when the expected return goes up, you demand more. If it is coming down, then demand also comes down, right? Okay. And third, the risk and the return, right? Risk of returns related to alternative assets, right? When the risk goes up, demand comes down. Here, you will have a negative relationship, right? When the risk comes down, your demand goes up. Clear? And then fourth factor, as we discussed, it's between liquidity and the demand. Here, that is positively correlated. That means when the liquidity goes up, your demand also goes up, right? Or vice versa, right? Here, like you could see these four factors, how they related with the demand of an asset. Clear? Any question? Now I have put that based on the textbooks. I have given that in a simple graphical way of showing this one. So you could see the arrows says all the stories. When the variable goes up, that means wealth or expected return or risk or liquidity, what will happen to the demand? Is that clear?
Yes, sir.
Yes, thank you. Yes. So in your exam, this is actually like postgraduate diploma. I hope like this is more than the exam. We should go with some kind of practical approach that should, give you some improvement or wider angle of, understanding. But still exam is very important. But in addition to that, my view is, okay, it should be, this discussion should be more than that. So sometimes these exams, you will be getting this kind of questions, but our understanding should be more than that, right? Okay, so keep in mind. And right now we are going to discuss, now you know the demand factors, right? What are the factors that influence the demand of an financial assets? Now we are going to talk about the supply and demand in the bond market, right? Now we are going to see a bond market, how the relationship between bond price and interest rate works. Clear? Okay. So for that, you could see, now you can understand at lower price, other factors, assume other factors are constant, right? Ceteris paribus, right? At a lower price, the quantity demanded of a bonds is higher. That we know, right? In a bond market, if you see a lower price, at a lower price, the demand of that particular bond may be higher, or inverse relationship. The same time, at lower price, when other factors are constant, the quantity supplied of bonds is low, a positive relationship. It's similar to goods market, right? When the price of the good is low, then you will have more demand. But if the price is higher, you will have less demand. Other side, supply, if you take, when the price is lower, then you will have a lower supply, right? And price is higher, you will have higher supply. So it's a positive relationship. So it's similar to goods market, right? But the problem is when you see the relationship between bond price and interest rate, right? We have discussed this one. What do you see? That is the yield to maturity of a discounted bond I'm talking about. Are you all with me? Okay. Here I'm talking about a yield to maturity. Can you recall how do we calculate a yield to maturity in a discounted bond? We have discussed this. Now, treasury bills, right? Let's assume face value is 100 rupees. It's always sold at discounted price. That's what we call a discounted bond. You bought it at 80 rupees. Now you have 20 rupees margin at the end of the maturity. That means if it is 1 year treasury bond, you got discounted at 80 rupees. So you invested 80 rupees, you got 20 rupees in addition for 1 year. That is yield to maturity. So what is your yield to maturity rate? You invested 80 rupees and got 20 rupees as a income. Then I is maybe 25%. Yield to maturity is 25%. Are you all following?
Yes, sir.
Yes. Okay. So this is a discounted bond. Even we talk about perpetuity, right? So that means console bond we discuss. We are like we divide this, cash flow by price, and then we got yield, right? So this is the yield we are talking about. Don't forget that, right? Okay. If you don't understand, let's see this one, right? I hope this is clear for you. Is it clear? Come on, I'm waiting for your response. Is it clear?
Yes, sir, it's all clear.
Yes, right. If you can see this graph, in the graph, you could see the title is supply and demand for bonds, right? I'm showing here a graph. You can see in the y-axis, it's a price of bond, that is P, right? And the x-axis, I'm talking about quantity of bonds. That may be quantity demanded or quantity supply. Here it's quantity, all in billions, right? We call it B for quantity of bonds. Now let's assume, okay, let's see. Now two lines are there. One supply curve, other one is demand curve. If you could see a curve, right? I don't know, my pointer can see you. Can you see my pointer here?
Yes. Yes.
Yes. Yes.
Yes.
So then you could see this is the supply curve, bond supply. That's what we call it, BS, bond supply, right? We discussed, right? When the price of the bond increases, the supply will increase. Now you could see the price is, the very first one is 750, 800, 850, 900, 950, and 1000. When the price increases, you will see the quantity supply increases. Quantity supply of a bond increases. But other way around, you can see this is the demand curve, right? So it's a usual demand curve. nothing different between good market and financial market. This is the bond demand curve. When the price is high, bond price is high, you will have less demand. And when the bond price is very low, you will have, high demand. Now you can see the intersect of these two curves. That's at a point C. That is the equilibrium of this financial market, bond market. Right? In that, you can see the equilibrium quantity is 300, right? And the equilibrium price is 850. When we talk about equilibrium price, we always call it P star. Right? Why I'm saying that, when you write in an exam, you always, if you mention P star, that means equilibrium price, or Q star, that's equilibrium quantity, or I star, that's an equilibrium interest rate. Right? Now you could see, let's assume the bond price is 950, right? When the bond price, you fix it at 950, right? So what will happen? You will have more supply and less demand. When the excess supply is available in the market, then the bond price will come down. Clear? Now, as you take an example, now government securities market, right? Government securities market. So now nowadays, what will happen to the price? You all are, most of them are from the banks, right?
Prices are going up.
Prices are
Going up.
going?
Prices are going down, right? The interest rates are going up.
Interest. Yes.
Exactly. You have, when you have more supply, right? Now, okay, you have the more supply now, right? So then prices are coming down, right? You have to have more discount, right? So prices are coming down, because like at a higher price, nobody is going to buy, right? So the prices will be coming down. So then, as you said, the interest rate will go up. Right? That means expected one, right? You expect more interest, right? Okay, we will leave it out that part. We'll discuss later. Okay, this is, I'm just talking about the prices, right? Nothing about interest here. Let's assume if the bond demand is high, what will happen? Now there are shortage of bonds, right? It should be other way around. So then everybody wants to have bonds, then price will go up. Now, when we think this bond market, don't restrict your thoughts within Sri Lankan market. You think about an international market as well. So because what I'm saying is, now you can think of the treasury bill, Sri Lankan treasury bill and US treasury bill, right? If you take these two bills, what will happen? Now these are two alternative treasury bills, US treasury bill and Sri Lankan treasury bills. Now you are going to choose one of them to invest, right? Now when you decide, okay, you have the excess bond in Sri Lankan market, you will see, okay, I can pay you less, right? So then, okay, demand is less, then automatically the price will be pushed down, right? So same thing if you have excess demand, a lot of people will be asking so many bonds, so then it will go up. Is that clear? Or just trying to pick up? Gavin, is that okay?
Yes, it's clear. All good.
Okay. I just told you about other markets as well, because always in an investor, not a local, maybe small holders, but big holders, they look at international market and see, right? In terms of, as we discussed earlier, in terms of liquidity, in terms of risk, and in terms of return, right? So now why I'm bringing this international bonds here, because like when you talk about risk, of course, Sri Lankan, if you take only Sri Lankan government securities, then treasury bill, treasury bond, they will have nearly same risk profile. That's what I brought here, international bond as well, right? Two treasury bills, right? One is US, other one is Sri Lanka. You can think of them. Okay, whatever it is, always think, because some of the analysis, some of the rationale or reasoning will not be matching to the explanation if we take only Sri Lankan market. You have to take it international market and see, right, to explain those. That's what I say. Okay, now you are clear now. Okay, in a bond market, what will happen to the price and the quantity? Okay, if that is clear, now you can arrive at market equilibrium. As I said, it occurs when the amount that people are willing to buy equals the amount that people are willing to sell, right, at a given price, right? Clear. So if the bond demand is equal to bond supply, that defines the equilibrium. That's a market clearing price, right? We can call it equilibrium price or market clearing price, and interest rate, right? So as we discussed, if the bond demand is more than bond supply, there's excess demand, then price will rise and interest rate will fall. We have always seen that, right? Okay, same thing when the bond demand is less than the bond supply, there's an excess supply, price will fall and interest rate will rise, right? Clear? Okay, so that's what I wanted to recall this one, right? So we are talking about the yield to maturity. So then when the price is lower, then interest rate is high, right? When the price is higher, interest rate is low. Okay, up to now, are you all clear how this interest rate is determined in a practical sense? You can see in a bond market. Now you can see in a government security market, primary market. So central bank will sell on behalf of the government treasury bills and bonds. Primary dealers will quote the price. Let's assume treasury bills, right? So the central bank also will give, in practical sense, kind of indicative price, right? Okay, and same time the primary dealers, you know who are primary dealers? Anybody? Who are primary dealers? Come on. There are a lot of things to learn. So like anybody can answer as soon as possible. Chaminda? No answers. You all can hear me, right? Raja Karuna, so silent today.
Dealers who are dealing in secondary market instruments.
Rangana, sorry, I didn't.
Hello.
Yes, go ahead. Go ahead, Rangana.
Dealers who are dealing financial instruments in the secondary market.
In the
Secondary market.
no, name itself says, right, primary dealers. Okay, you are nearby, but anyway, like the dealers who are dealing in the primary market, right? That means like whoever going to buy from central bank, so then they are the primary dealers, right? So central bank gives the license to them, like whoever can participate, maybe licensed banks, or there are primary dealers which are not banks, so they can give the license. Okay, these are the people can come to the primary market and they can quote their price, right? So basically in the primary market we call it bond market in a common name, right? Government securities market. So like they will quote the price and central bank will decide what is the cutoff, that means equilibrium price, right? So when you decide the equilibrium price, that itself will tell you what is the yield or interest rate. This is the practical point of view I'm telling you. So every market, so maybe most of the time in a month there may be 4 auctions, right? We call it auctions. In the auctions, like primary dealers can come and quote that. So then we will have different prices maybe for different auctions. So then nowadays you could see, like we say interest rate nowadays little bit increasing, right? When you have the price, then you calculate the yield, right? Interest rate. So that's how it works. Is that clear? Anybody wants to have any practical questions on that? I highly encourage you all to get into kind of practical aspect as well. Okay, now the question is, interest rate is now you arrived, right, based on the market equilibrium. But market interest rate changes, right? That changes. What are the reasons for the market interest rate to change or equilibrium interest rate to change? If anybody can tell you. Shall we go one by one? Shaminder? Now we know, like, market equilibrium is... Sorry, go ahead.
When an interest rate change, equilibrium change.
Yes. Okay, before that I'll tell you, the market changes or market equilibrium price or equilibrium quantity, right? Here equilibrium interest rate or equilibrium quantity, we can say both ways. It can be changed based on 2 factors. It's a primary factors, or changes in the demand or changes in the supply. The price and quantity cannot change themselves without these factors, because these are the deciding factors. Now tell me, now you have seen this graph. If you see this graph, this curves, this demand should change or supply should change. Then only we will have changes in the interest rate. Just tell me, what are the factors that can change the demand of a bond? So changing a demand, you can change the equilibrium price, right? Okay, what are the factors? It's same factors what we discussed. If you have more wealth, you demand more, right? That's one thing. And second, expected return. You expect higher interest rate in future, then you will have more demand. Or if I explain further, like based on the textbooks arguments, okay, if you expect higher interest rate in the future, lower the expected return for long-term bond, shifting the demand curve to the left. Okay, I don't want to like show the demand curve now, but you can understand. Okay, if you have more expected return, you will demand more. And this, the next, leave it out for a while, expected inflation, just talk about risk. If you feel like, okay, riskiness is increasing, you will have less demand. And then liquidity, if you see, okay, liquidity aspect is increasing, it is more liquid now, then of course your demand will increase. These are the four factors we have already discussed. But one more factor here, it's expected inflation. If you see expected inflation would increase, what will happen? Your demand will be less, because you will see, we have already seen the nominal and real interest rate. If you see inflation is increasing, what will happen to the real return or real interest rate? Anybody?
Return will be low if
Return will be real return, exactly, real return will be low. So then when your expected inflation increases, you don't buy the bond, right? So these are the factors that will change the demand curve. Is that okay? Right, that's, you can see here in this picture, right? And increasing the demand for bond shift the demand curve rightward, right? So here, like you can see, this is the blue color is the initial one, that's what BD1. Then the demand curve shift to BD2. Because of these factors, your demand curve shift rightward, right? Now, now you can see, this is the critical explanation here. Now see what will happen for each and every factors, what will happen to the demand curve. First, if you take wealth, when wealth increases, right, what will happen? Your demand will increase. So when the demand increases, the price of bond will increase. Clear? And second, if you see expected interest rate, if that is the variable that increases, then you will have, right, I'm talking about the expected interest rate, right? Futuristic interest rate. Here you can see the bond price will come down when the interest rate increases. Is that clear? If you interrupt me anytime, right? I don't know, just you all are following me. I would see. Gavin, is that okay?
yes, sir, it's all clear.
Okay. So then we could see the expected inflation as we discussed. When the inflation is high, right, you will have less demand. right? And then riskiness of bonds high, you will have less demand. But when the liquidity of bond relative to other assets, always we compare to other assets like these things, okay, you will have more demand, right? So keep it clear. This simple summary table will give you all factors into that, right? Here, like second item, you have to always think, right? Here we are talking about the expected interest rate, not the particular bond, expected interest rate, right? Okay, other hand, now one side, the equilibrium will change because of the demand changes, right? We have seen what are the factors that have impact on the demand. Other side, even the supply changes that will have the impact on equilibrium, right? So here we are talking about what are the factors, right, that would have kind of influence on the equilibrium, right? The factors that influence the supply and that in turn have the impact on the equilibrium, right? In this chart, we could see three kinds of reasons that influence the supply of a bond. The first one, expected profitability, right? Now, if you think expected profitability of an investment opportunities, right? Now let's assume a government, they wanted to have a kind of big factories, right? They need a lot of money, and big factories also, they think, okay, like the airport, if they like think, okay, they are going to get like highly profitable business out of there, then they wanted to build a bigger one. So then they will borrow the money through giving or supplying more bond to the market. So when the expected profitability of an investment increases, you will have more supply of bond. So supply curve move from B1 to B2, increasing supply. And second, the expected inflation. Now here, like I also like always telling you, the expected word is very important. The inflation at now, that is, we call it inflation, current inflation, and then expected inflation. These are two different kind of meaning, and the impact will be different. So always keep in mind, when we say expected, it gives a different meaning, right? The meaning is as usual expected, but the impact is totally different than a current inflation, right? So if you think expected inflation is high, you will have more supply bonds. Why is that? If anybody can tell me. Rajakaruna, what I'm saying is, you feel, you are a issuer, you feel expected inflation will be higher than expected. That means futuristic view. You supply more bond. Why?
The inflation, expected inflation is, I mean, that is high. So expected inflation would be high. So that the government need, I mean, there is a so that so I mean,
Yeah.
there is a
Go ahead.
And so can you repeat the question again, please?
Yes. When you feel like expected inflation is high, let's assume you are the bond issuer. You feel expected inflation will be high. That means future inflation will be high. So you tend to supply more bonds or issue more bonds. What's the rationale?
In order to meet this the requirements, so need to increase that bonds. I mean, that is because that is related to inflation. I mean, the issuing bonds positively affected. I mean, bonds against the inflation.
You mean to say like, okay, you will have more more expense than previous, so then you will issue more. Is that so?
Yeah, that should be there.
I didn't get your point. Anybody else? Thank you, Rajakarna. Yeah, some extent we can think of, but not to the point. So anybody can add to Rajakarna's point. Economics, I just want to say that as well. It's very confusing, right? Very confusing subject. That's what always we say when other factors constant, right? If you leave that or if you remove that part, everything is confused. And I could remember the president's name, US president's name. He said he wants one hand economist. Anybody heard this story? He said, I need only one hand economist. Because economists never give a solid answer. They will say, okay, if you increase this variable, that will increase maybe like assume price, but other hand. So they have always an argument, opposite arguments, right? Always, and say, okay, it will happen, but other hand, you also have this kind of impact. So two hands, always more than one hand they talk about. So that's what president said. I need one hand economist. Give me a solid answer. So why I'm saying this, always confusion, unless we say, okay, we have to wipe everything from our mind and say, okay, these are fixed. Don't worry about that. You only think about. That's what we always, when we talk about demand curve of a good, as I explained the previous sugar example, when the price increases, right, demand will go down. We say it. We put a condition saying other factors are constant. If you remove that condition, if the price goes up, let's assume my income also goes up, so then demand will go up. You can't arrive into a conclusion. That's what we always say. Okay, other factors constant. So you think about only the price and demand. And when you say price and demand also, some people also get confused in the sense like, okay, when we discuss, students get confused. Okay, when the demand goes up, what will happen to the price? When the demand goes up, what will happen to the price? Don't think about like that. We are talking about the relationship between, okay, price is the independent variable and demand is the dependent variable. So it's within that, so many, thoughts are there. We should be very clear what we are, what we are focusing on, right? Okay. So in this example, I'm saying, okay, when the expected inflation is higher, that means future inflation is higher, right? Bond supply will be more higher. Anybody else? Take you as a corporate. You are going to issue a corporate bond. I'm talking about the corporate bond now. Let's assume when the interest rate or expected inflation is higher, I'll be trying to issue more corporate bonds. Why is that? Dilshani? Or Dilushi? You could think or not. Gavin, can you think of anything?
So this is the same question, right, about profitability of investments, right?
What do you mean?
Like the question, can you repeat it again? I'm a bit confused.
Yeah, the question is like, okay, this says, okay, when the expected inflation is higher, the bond supply will be higher. The bond supply curve will move rightward. Why is that? That's the question.
Is it because comparatively, so because the demand is getting lower to compensate that, like, come to equilibrium state? I don't know, I'm not exactly sure.
Okay. Fine. Just think about, I don't know, like everybody's following this one, and at least if you like Dilshani, delusion, or like if you don't understand, ask me, like interrupt me and ask me. Like if you all are silent, I don't know what's going on, right? So it's better if you all can say, okay, whether you understood, or if you don't understand, share with me, right? So actually what I want to say here is, like, you have to think that extent, right? Otherwise, like kind of I don't want to, that's what I said, like I don't want to have this kind of discussion as like based on only the theory, right? Just think about practical aspect, because like you can understand more when you have that kind of understanding. Okay, now expected inflation. Okay, now when I'm just the issuer of bond, I think the expected inflation will be high. That means, okay, next couple of years, the inflation may be higher than today. So now let's assume I am issuing a bond, 10% coupon bond I am issuing. Today, the 10% I have to pay, right? But tomorrow also, I am going to pay 10%. But now tomorrow's real cost for me is less than today, right? What do you mean by real cost? Now you can think of nominal interest rate, real interest rate. So now today I am fixing, okay, nominal interest rate is 10%. That means assume today real also zero inflation. Today real also 7 or 10%. But tomorrow when the inflation comes as of 5%, then what I'm going to pay, my real cost is only 5%. So the purchasing power of the buyer of the bond, kind of, or income of that bond, is very low. So for me, it's profitable because my cost will be lower in future. So I tend to issue more bonds if I feel expected inflation is higher, right? I think you all got it, right? Think of in any scenario, right? Keep in mind, I don't want to, take more time on this discussion. Just get involved in the discussion. That's what I can say, please. Okay, so then, just go.
So if it is, so just to clarify, so when the, the supply is high, so from the perspective of the supplier, you are saying that, because it's, because the return is going to be low. So is that what you're trying to say? It is profitable because of that, because the return to the invest is low. So from the supplier's perspective, it is profitable. That's what you're trying to say, right?
Cost of borrowing, real cost of borrowing will be low. Yes, that's what I'm saying.
Okay, thank you.
No worries. Right. So the third one, government deficit, that we know. If you take a government bond, if the government deficit, budget deficit is higher, then they will tend to issue more bonds. That's what, like, people always look into the budget before announcement and all, and see, okay, what will be the deficit, or is there any surplus? So they tend to forecast the bond market behavior based on the government announcement, right? Like most of us, we don't worry about the government budget in the sense, like, whether it's deficit or how much and all in detail. We worry about the budget, but not into that details, in the sense, not like bankers or like officers level I am talking about. So, but if you want to forecast a bond market behavior, these are very key, right? So third factor that influence the bond market supply curve, so that is government deficit, right? So now we have seen the factors that influence the demand of a bond, the factors that influence or shift the demand curve, or the factors shift the supply curve, we have seen, right? So what will happen? Something change on these factors, right? Here, this is the supply curve, right? Based on the factor changes, the supply BS1 move into BS2, right? Now you could see this is the response. Now changes in the market price and the quantity. So now you know how interest rate is determined and how that changes, right? Okay, now come to this point, I want to just discuss what will happen if expected inflation changes. Okay, first you can see here step 1, 2, 3, right? You see the step 1, a rise in expected inflation. Okay, we assume the expected inflation is high. So a rise in the expected inflation shift the bond demand curve leftward, because like the buyers of the bond, they think, okay, the expected inflation will be higher, so then my real return will be lower. So then the bond demand curve, it will move from right to left, right, leftward, and it's from BD1 to BD2. But similarly, what will happen to the supply? They supply more, because that is beneficial for them, because real cost will be less. So they will issue more bonds. So then a bond curve, the supply of bond curve will move from BS1 to BS2. That means rightward. Now you could see the reds are the new changes to the demand and supply curve. Now according to these changes, right, price will come down because you have more supply and less demand. The step 3 causing the price of the bond to fall and the equilibrium interest rate to rise. So when the bond price, right, decline, then automatically you will have high interest rate. You can simply apply this model to our government securities market and see. You see, okay, expected inflation will be high. Okay, you have more supply, now less demand, prices are coming down, then your interest rate will go high. Is that okay? Now, you know, like, even though like we always talking about, okay, treasury bills, nowadays treasury bills are going up and all these stories, these are the mechanism behind to that. Clear? One is maybe expected inflation, other one maybe government deficits, okay, whatever it is, right? You will ended up with this kind of equilibrium. Any question? So up to now we have seen the interest rate determination, or how an interest rate is determined in the bond market. That means you take financial assets, right? There's a demand and supply for the financial assets. Finally, you will end up with the price and the quantity, right? Based on that, you see the interest rate. Any question up now? It's a key theory, right? Always you have to see the bond market and see how that interest rate changes. Rangana, is that okay?
Okay, sir.
All right, thanks. Okay, the second thing, up to now we have seen the bond market. But there's another thought. It's developed by John Maynard Keynes. We call always Keynes, right? Everybody knows when we say Keynes, right? He developed another alternative method, right? It's instead of using the bond market, he say, okay, we can arrive this interest rate equilibrium based on the market for money market. He says, okay, this interest rate equilibrium would be arrived using supply and demand for money. Right? So let's see how that works. In this theory, we call it the liquidity preference framework or liquidity preference theory, right? In this theory, he says, okay, we can have money or bond. Now you have a wealth or saving. What you're going to do, you can have a money with you, or you can invest on a bond and have bond with you. There's financial instruments. You can alternately, you can keep one of those. Right? If you take the total wealth of the economy, right? If you take total wealth of the economy, the bond supply plus money supply, that's a total wealth that should be equal to bond demand and money demand. Right? If you take, are you all following? if you take the total wealth of the economy, you can keep it as a cash or you can keep it as a bond. These are two alternatives, right? So then if it is at equilibrium, then the bond supply and money supply altogether should be equal to bond demand and money demand. Right? I have given here, if you rearrange this one, the bond supply minus bond demand should be equal to money supply minus money demand. So he arrived that in a money market equilibrium, you will have money demand equal to money supply. In a bond market equilibrium, you will have bond supply equal to bond demand. Right? So now he says, based on this money market equilibrium, you also can arrive interest rate. This is the liquidity preference framework the Keynes developed. Let's assume, or let's see this chart or graph. Equilibrium in the market for money. Right? Here we are talking about money, right? Now you could see this chart graph. You can see in the y-axis, that's the interest rate I, and the x-axis, it's a quantity of money, M. Are you all following? Chaminda, is that okay?
Yes, sir.
Okay. Now, earlier we saw interest rate determination can be arrived through bond market. But we are looking at the alternative model that's developed by Keynes. Say, okay, we can go through money market and see how interest rate is determined, right? So if you look at this graph, as I explained, right? Now here in the money market, we are going to see money supply and money demand, two curves. Where in the bond market, bond supply and bond demand. Let's assume this blue color, right? From top to bottom, sloping left to right. This is the curve, money demand curve. Here, if you see how much money you want to hold at a different interest rate, that's a money demand. I'll tell you the example now, in a simple layman example for understanding. Now you are earning money, right, or salary. How much you want to have a cash with you? That's a question. That's a liquidity preference. You want to, now you have two alternatives. You have to clearly, understand and follow me. You have two alternatives. You are earning money now. You are getting salary. And you have serving now. You have two alternatives. Keep it as a money or invest on bond. This is what you can do now by your serving. You can keep it as money or you can invest on bond. Right? So two alternatives. Here, liquidity preference framework, or you want to keep it as money. Let's tell me, I'm going to ask you all, if there's the interest rate is very low. I'll go with Dilshani again. Let's see whether she answers or not. Right? Okay. Very low interest rate. What will you do? Don't ask me what is the question again, right?
The interest is low.
You keep your saving as money, or you will go for a investment on bonds?
Keep serving the money because the interest rate, the return is low.
Correct. Now, if the interest rate, okay, return is very low, you are going to keep, you're going to choose, right? Alternate with two assets. One is liquidity, other one is liquid money, or otherwise bond. You will think, okay, very low interest rate. What's the point of investing on that? Keep it as a money, right? So you can see at a very low interest rate, let's assume 5%, the money demand is higher. You want to have money, the demand will be higher because you want to have more liquid with you. Now, in a practical sense, you assume, now there's an interest rate, deposit interest rate is 3. You just don't want to invest on anything or invest on deposits. You just get the money and spend it because the 2%, sometimes maybe real return may be zero, like minus, but it's not worth for you sometimes, right? So similarly, let's assume the interest rate is very high for bond, 20%. Dilushi, tell me, if you see, okay, high interest rate for the bonds, what will you prefer? You want to have money with you or bond? You want to invest on a bond?
Invest on bonds.
Exactly. Am I pronouncing your name correctly?
It's Dilusha.
Okay, sorry, mate. Okay, Dilusha.
No
Okay.
worries.
Okay, Dilusha. Right. So you will have more bond because you will have, high interest rather than keeping money. So this is the liquidity preference, right? Liquidity preference based on so many factors, but this is one of the factor. Expected return, right? So here, that's what you are, when you see the relationship between interest rate and the quantity of money, when the interest rate is high, your demand for money will be low, and when the interest rate is low, your money demand will be high. Is that here? And then it will come to movements when you meet with the supply curve. Let's assume this is totally different. You should always understand this one. This is the trick point here. Have you all seen this supply curve like this all anywhere? Now you can see money demand, now. There's a supply curve, money supply curve, MS. What do you mean by this money supply curve? It's a straightforward line standing parallel to the y-axis. Straight line standing parallel to the y-axis. What is the meaning of this? Hold on for a while. But you can tell me the answer. Anybody? No answer?
So the quantity of like money is constant irrespective of the increase or decrease in the interest rate.
Exactly. That is the explanation. Very good. Now you could see here. Yes. Irrespective of the changes in the interest rate, money supply is fixed. You won't be seeing this kind of line in anywhere, right? This is a special line drawn for this money market, right? That means don't think when we say money market, it may be slightly different meaning when you talk about markets. That's what it always we call it market for money, right? In the textbooks it says market for money, right? So okay, why is that? Why this is a straight line parallel to y-axis? Anybody? Visista? Sorry. Come on. Oh, I'll go back to Rangan.
Money supply is determined by some other factors than interest rate.
Pardon, Rangana? I didn't get it.
Money supply is determined by other factors than interest rate.
If you can elaborate, yes, that's true. So what are those other factors?
Liquidity in the market.
Okay, yeah, some extent agreed the point. This money supply, who decides? Who decides? The quantity of money supplies, who decides? Come on.
Central bank.
Exactly. The central bank will decide, monetary authority will decide how much money should be in the circulation. Right? So this money supply always constant in the sense irrespective of the changes in the interest rate. Right? Money supply would be like this. It can move left or rightward. That's of course okay, but it would be always due to the various factors. It can the supply curve can shift left or right, but this would be always parallel to this y-axis because it decided by central bank. Right now, money supply is okay fixed, but demand changes based on the interest rate. The curve is like this, and then the equilibrium might be the quantity of money is 300 and interest rate would be 15%. This is the equilibrium interest rate. Right? Okay, let's assume now 25% interest rate. What will happen? Right? The central bank money supply is this line, 300, it's fixed. Now 25% interest rate, right? The people want to have their money in bonds, then they demand money less. So this will come down. Right? Demand will come down and settled at C. If there's an excess supply. If there's an excess demand, what will happen? You have 300 anyway, but you have excess demand at 5% interest rate, because like people are thinking, okay, no point of like investing on bonds for 5%. I keep it as liquid. Then what will happen? The interest rate, so the people are, demanding less. Then it's by the time little, interest rate will go up. Is that okay?
Can you repeat that, sir?
Hold on for a while. Okay. Now we are looking at this market, money market or market for money equilibrium. Money supply is a straight line parallel to y-axis, and then the money demand curve, right? It's moving towards top to bottom and left to right as usual, right? If you see this one, the first you see here, when you have excess money supply, right? If you take this 25% interest rate, the money supply is fixed, nothing changed, because we already understood that irrespective of the interest rate, the money supply is fixed because that is given by central bank, right? But now the interest rate is 25%. That means people will try to invest on bonds, not keeping as instead of keeping money as a liquid form. Then everybody goes to a bond. What will happen? Then interest rate that will come down. Clear? Okay.
That is because the demand for bonds are increasing. The
Sorry?
rate goes down. That is because the rate demand for bonds are increasing.
Exactly. Now you can recall this bond marker. When the demand for bond increases, right? What will happen? Price will increase. When the price increases, interest rate will come down. Is that okay?
Okay, sir.
Yeah. So it's vice versa, other way around. Okay. Now let's see at a interest rate at a 5%. Let's assume 5%. Money supply is fixed, but you will have excess demand because you think, okay, I don't want to invest on bonds. I'm going to keep liquid the cash as liquid assets with me because no point of investing at this lower rate, right? So what will happen? Then people don't go to the bond. They will keep money here. Then automatically interest rate will go up. It's other way around, right? Vice versa. Is that clear? Here again, you will end up with the equilibrium. Now it's the same explanation. Now you don't buy the bond demand will come down. When the bond demand comes down, price will come down. When the price comes down, interest rate will go up. This liquidity theory Keynes build up based on this alternative scenario. That's what I earlier said. Whether you are going to keep it as cash or whether you are going to invest on bond. And there we talk about bond demand and supply. Here we talk about money supply and money demand. Is that clear? Rangan, is that okay? Or like?
Yes, sir.
Okay. Now, the demand for money in the liquid preference framework. What's happening? As the interest rate increases, the opportunity cost of holding money increases, right? When the interest rate increases, what happens? Okay, if you're going to keep money with you, the opportunity cost. What is the opportunity cost? What is mean by that? A loss of not going to another alternative assets, right? That's opportunity cost. So if you want to hold the money with you, then you can't invest on bonds. So your opportunity cost, when the interest rate going up, you are going to lose more. That's opportunity cost for holding money, right? That is increases. And then relative expected return of money decreases, right? Now, when you compare the bond, the relative expected return, right, of money decreases because it's an interest rate increases, right? Therefore, the quantity demanded of money decreases, right? When interest rate increases, quantity demanded for money decreases. So you can keep this in mind. This I explained earlier, right? Now the question is, as we said, now we have seen market equilibrium for money. Now, as in the bond market, we are going to see what happens if some factors changes to the demand for money curve. Let's see the next one. Shift in the demand for money. What are the factors that can affect the demand curve of money? If anybody can tell me. Now let's assume you want to have cash with you, or more cash, less cash. What are the factors you take into consideration when you decide on that? Demanding money, preference to hold the money with you. What are the factors you can think of? Come on. I don't know whether it's too tough. I didn't think so, but
not having a necessity to invest.
Gavin, I didn't get your point.
Like, having a sufficient income that you don't need to like use it on other instruments.
Not sufficient?
No, I mean having a sufficient income. Can you hear me?
Exactly. True. Yeah. Now, if you have more income, you will have more demand for money. Now, let's assume. Now, if I'm earning like 1,000 per day, I will keep 1,000 at least. That's the maximum I can do it. If you have 1 lakh, right, then you will have 5,000 or 10,000 with you, right? When the income increases, you will have more money with you. The reasons are there actually, like for several reasons we can see, right? But here, income effect. That means a high level of income causes the demand for money at each interest rate to increase, right? And the demand curve shift to the right. We know, like when these are the other factors. Earlier we said, can you remember? Other factors constant. Here we are looking at the factors that shift the demand curve. One is income effect. So when the income increases, you demand more money, then that shift to right. Okay. Now here also I have given the reasons, like the rise in the income causes wealth to increase. Then people need to carry out more transactions. You try to buy more things, right? If somebody wants to buy maybe one shirt, you may be buying few shirts. So you want to have money with you, right? So don't confuse a lot of, with credit cards and other alternative ways of buying. Here, this theory is, like it's some time back, right? So then it's basically talking about the money. You should understand in that context. That's what I always say. Don't bring it everything together and confuse it, right? Okay. So people try to have more transaction, but in a broader sense, it's still applicable, right? Don't worry about that. That's income effect. And then second, price level effect. You want to have more money. Now you can see nowadays, people want to have more money in their hand. Because you may think, okay, the price will go up, so I have to spend more, right? Or any item, consumable items, or any electronic items. So the price will go up. If the price will go up, then you should have more money with you, right? So then that also shifts the demand curve of the money to right. So a rise in the price level causes the demand for money at each interest rate to increase, and the demand curve shift to the right. Is that clear? Now we have seen, right? Okay, demand curve shift. Now when it comes to supply curve, we know, as I discussed, the money supply is controlled by the central bank. Only the central bank can shift the money supply curve. Right? Clear? Yeah. Here I have, it's a textbooks anyway. They were talking about the Federal Reserve. That's the central bank of US. So they decide. Right? Clear? Right. Now you could see in this graph, what will happen if money demand increases. Right? In a liquidity preference theory, we know the equilibrium and we know what will happen to the money demand curve. When the income increases, money demand increases, right? The curve shift from BD1 to BD2. Then what will happen? There's no change in the money supply. Then interest rate increases. If you take the price level, when the price level increases, you can think of inflation, right? When the price level increases, then money demand increases. So you can see in the graph, the money demand moves from MD1 to MD2, then interest rate increases from Q1 to Q2. The money supply, when the money supply increases, right? Here the final, that is central bank make the changes. When the money supply, like the curve shift from left to right, what will happen? Interest rate coming down. Clear? Okay. If you have any doubts up to now.
So can you explain the last one again? Because the government, how should come the interest rate down when this thing? I mean,
Okay, now we have seen. Okay, now when the money supply increases, right here. Now this is your money demand curve, right? So now you will have no change on the money demand curve, we assume. The initial equilibrium is I1, right? This is the blue one, right? So now the money supply increases in the economy. Overall money supply increases, but money demand, nothing happening, right? So you have less money demand but shifted to more money supply. Okay, so now people will have more money. What will happen then? If you have more money, then interest rate. Now take this as a money market. Let's assume, okay, I bring the bank into this. If you have if you want more understanding, right? Now it's highly liquid. Take money market. The central bank increase the supply. So the money market is highly liquid now, right? You can easily borrow from bank to bank. You get easy money. What will happen? Then every bank's trying to lend you. You will have then a better rate, right? More money supply means more liquid the market. The more liquid the market means you can get sufficient money at a lower price, right? So the interest rate will come down.
okay, got the point, sir.
Yes. So here, like, I don't want to go into more detail for your understanding, but there are we call it the transmission, monetary policy transmissions, right? Mechanism we'll be discussing at the later stage. When central bank changes something, that impact will be passing through so many agents or so many areas and finally goes to the general public. We call it transmission mechanism, right? So there can be so many transmission channels, right? The impact. Now let's assume the central bank issue more money. The impact can go through banking sector. That's we call it interest rate channels, or through banks or foreign exchange rate, right? So something like, or maybe expectation channel. So something like that. I don't want to confuse, but there are if you go to in detail, we can look into that. Here, this works like this, right? So for your easy understanding, I've given that. So then this would be the ideal case for explanation for this table. Okay. Now you could see, like, I think sometime back, the money market, right? Where the banks, borrow. Oh. Yeah, sorry. So banks easily borrow, and sometimes, but may not be appropriate for this today's class, but I'm just tell you, sometimes central bank tend to supply more money. Thinking of that, okay, just to have some understanding. Why in this corona pandemic period, central bank, no, not only Sri Lankan central banks, world over, even not only this time, in 2007-8 financial crisis or 10-11, central bank issued more currencies. So that means increase the money supply. Why is that? I'm going to ask you all one by one. First in list, I think today. Yeah, go ahead, Rangan.
Because they want to increase the private credit in the market by supplying funds to the market to generate income through businesses which are affected. So by for that they reduce this statutory reserve requirements and available credit to the market was increased.
Yeah, not clear, Rangan. I understand, but I don't know others hearing properly.
Hold on.
Others also got it, that what Rangana said?
Can you hear me, sir? Can you hear me?
Yeah, Rangana, go ahead.
So central banks reduce their statutory reserve requirements and arrange to pump more funds to the market in order to reactivate the economic activities in the businesses which are affected by this pandemic. And in that case, the overall lending rates came down with the availability of funds to the banks for more lending. So that increases the economic activity. That's the thinking behind that move, I suppose.
Exactly. So anybody wants to give some more hints on that? What Rangana said is exactly correct. In a crisis situation, central bank tried to pump more money, right? So the reason behind that, as Rangana said, they want to stimulate the economic activities, right? Anybody wants to have something from their mind mapping? Sorry. The economic system we discussed. Okay, so just to link to that as well, because always have the link on that. So economic system, we know what is the economic activities, and there we fix it. What is GDP? We know what is GDP now, right? There are three approaches, right? We learn. And if you want to activate like economic activities, means you want to have more GDP, right? You want to increase your GDP. Just recall, there were three approaches we discussed. If anybody can recall how we can calculate GDP, you should. It's high school economics, right? Three approaches. Dilshani? Yeah. Go ahead, Gavin.
Yeah, the aggregated output, aggregated income and expenditure. Are those three?
Very good. Aggregate output, aggregate income, aggregate expenditure. Can anyone tell me, like, okay, aggregate expenditure? That means if we increase the aggregate expenditure, that means that increase of GDP. If you want to increase the aggregate expenditure, what should you do? You have to increase the components of aggregate expenditure. What are those components in aggregate expenditure? Dilshani? Dilusha? Dilusha? Can you remember or no? Is Visishta there?
Yes.
Why don't you tell me then? That is the formula you have to take everywhere when you go. As a banker, Rangana, can you tell me?
Can you repeat, sir? I didn't get it.
Yes. When you calculate GDP and the expenditure method, what is the formula you use? Can you all remember? Okay. Can you all remember like y is equal c plus I plus g plus within bracket x minus I? Can you all remember? That means y is a GDP that is equal consumption, investment, government expenditure, and then export minus import. Can you all remember?
Yeah, sir.
Yes.
That's the equation, right?
Yes. That is, you can never forget that, because everything's when you have more analysis, you are going to analyze consumption, you are going to analyze investment, and you are going to analyze government expenditure, export, and import. Right? That's a very crucial formula. You can link to anything and everything, right? So here, like if I want to increase, think about, okay, if I want to increase GDP, what we can do? We can increase consumption. We can increase income. We can increase government expenditure. We can increase export. And we can decrease import. Is it clear? Rangana, is that clear?
Yes.
Yes. So now, now world over, in a crisis situation, we should increase GDP, or like that we call it expansionary strategy. We should increase the GDP. So then, as an example, if you want to increase the GDP, you have to increase the consumption. People should consume more. If you like promote the people to consume more, they should have more money. Then central banks all over the world, they increase their money supply. So people tend to increase their consumption. The producers tend to produce more, right? Because in an economy, I don't know, this level you understand or not, the GDP can be increased through two ways, right? That means like, okay, one, you can increase the production, or you can increase the demand, right? So can we increase the production to increase the demand in a normal course of business? There's no crisis, not at all. The economy is performing as usual, normal. If you want to increase the production, what we should do? Just anyway, it's anyway, like I'm just a little bit moving from the subject, but I think everybody should know this. In overall perspective, think as a country. There's no crisis. We are doing perfect, but we want to increase our GDP. What we can do?
Increase the purchasing power of people by.
You're still going with the demand side, right? Okay. Now, okay, let's assume. Okay. Now, if you want to increase the production of an economy, bring that economic system. If you give more production factors, economy will produce more, firms will produce more. What are those production factors? Capital and labor, right? Or land also is a real capital, right? So can you overnight increase your capacity for production? No, because labor growth, it will take some time. Land, of course, capital is limited. Only thing is, you can increase the capital, okay, in a longer term. You can increase the labor in a longer term, or like if you can't increase, you can increase the productivity. That also you cannot do now. Today you ask your guys to produce 10 units, and tomorrow if you ask your guys to produce 15 units, he cannot do. It's a longer term process. The high skilled human resources. These are the ways you can increase the production in a supply side. It's always longer term. That's what you cannot have that kind of ideas in a crisis situation. You don't touch the supply side. You always tend to supply demand side. As Rangana said, how to stimulate the demand? That's what I say. You try to increase the consumption. So when the consumption increases, it's a short term. Immediately you can increase. Then in a crisis situations, the factories can still continue their optimum level, not going like beyond the optimum level or like in an expansionary way. But if you don't stimulate, consumption will come down, and then this also will come down. So we have to survive in between. Even if it is like beyond that point, even for shorter period time, the companies can have more overtime, and all these people like get work a little bit more and produce a little bit more, because this is coming from demand side. That's what in a crisis situations all over the world, not only in Sri Lanka, even in the US, even in the German or Australia, even the wealthy economies do more compared to us anyway. They try to supply more money. Then, as Rangana said, it will go through the banking system and reach the public, and they will demand more money. And then they will consume more. GDP can be, not stringing too much. You can survive that crisis situation. Because otherwise, if you leave out, then all these production units, smallholders, everybody will die. And then finally, it's in bringing to the normal situation may be so difficult. This is what happened in 2010, 11, or like after this financial crisis, and now it's pandemic. Everybody's doing. There are several ways doing that. As Rangana said, you can reduce the SRR. You give more money, access to more money, liquid, high liquid. But in a developed countries, what they do is actually, they call it, I think, the Federal Reserve Chairman, I think, Ben Bernanke, I couldn't remember name. He introduced that helicopter money. What is that helicopter money? Anybody can understand? To stimulate the economy, you give helicopter money. That's a economic wording now. Dilution. What is mean by helicopter money? Can you tell me or not? Dilusha, come on. Or
Sorry, sir, I have no idea about that.
that's fine. That's fine. Okay. Chaminder, you are so silent so long. But anyway, you talk. Yeah, go ahead.
No, sir, no idea.
Okay. Okay. So when you say helicopter money, they introduced during that financial crisis. Actually, it's kind of if you fly on a helicopter and just throw away money, what will happen? It goes to the public hand. Then they can, stimulate, their consumption, and then you can keep up the economy going, right? So what they did is, rather than flying with the helicopter around and throw away money, they put like maybe $500, $1,000 to each and every household's bank account. This is free, right? You take the money and spend, because they are very, very strong economies. They can do that. Can we do it here? But still, some of the like 5,000 rupees we issued, can you remember? All forgotten, because we all are rich people, right? Can you remember? Yes, say yes or no.
Yes, sir.
Yes, that is the helicopter money. We go home to home and give 5,000 and spend. Come on, guys, spend, right? So it's like that here, because we are not developed as such a financial system in US. US, like they all banking account are linked to, they have this, facilities, and what you call, some different names are there for name. What is it? Check. Paychecks, they call it. If some people are earning below $2,000, they will get money, additional money. If you have 2-3 kids, you will get additional money. So those are well developed and strong economies, they can do that. So that's free money you can buy. Here also, like whoever like cannot do that, so we also used to our level best, we try, right? We gave free money. That's similar to helicopter money, right? We try to stimulate, increase the demand, and we hope like economy will be going as smooth earlier at a later stage. Otherwise, if you give up, definitely all factories will be closing down. No more production. Even if you try to be back to normal, you won't be able to do that, because already closed, right? This what interim measures we have to take it here. Like, okay, so back to the discussions. During this pandemic, we reduced SRR because we wanted to have banks to have more access money. Okay, use it. I couldn't remember, maybe several hundreds of billions, right, released from SRR, and bank used that. So when the bank used that, so excess liquidity in the market, your rate is very low, right? But now tell me, because you all are bankers, I'm just asking you to your understanding. Now SRR has been reduced to 3%. Now market is highly liquid. You have excess liquid. But central bank wants to promote still more activities or more demand for consumption. What central bank can do? Can central bank reduce further SRR? Anybody? Is my question clear? Dilshani? Gavin, is that my question clear?
Yes, it was clear, but I'm not really sure about the answer.
Fine. Now, the question is, okay, the central bank reduced the SRR, that everybody knows. Now, market is highly liquid. The banks are using that money to lend more, but still market has liquidity, excess liquidity. Because we know how much we release and how much gone to the public as a credit. Okay, still there are the market is highly liquid. So central bank, if central bank reduce the SRR further, there won't be any changes because already market is highly liquid. That's what sometimes even, okay, to push the market, central bank reduce continuously SRR, but the banks are not lending sometimes because already liquidity is there, but bankers are not lending. So no point of reducing the SRR again and again where the bankers are not lending to the public, right? So in this argument, okay, when the liquidity is high and high and high, your interest rate will come down and down and down again. Is that okay? Clear? I hope up to now it's yes. So here I have mentioned the response to changes in income or price level. You could see always when it comes to market for money, right? And then liquidity preference framework, you could see the money supply is constant, it's fixed, right? That's what we draw M and then we put a line here, top of that, right? So it's given, right? Step 1, you can see a rise in income or the price level shift the money demand curve rightward. We know that, right? When the money demand increases, what will happen? So there's no change in the money supply, so then interest rate will increase, right? So you should understand whenever you answer a question, if somebody is giving a change in the variable, maybe inflation increases, price, or like any other rates increases or any other factors increases. So you should think about first what will happen to the money demand and draw and see it. Or what is the changes? What is the change in the interest rate? Right? I hope you understand. And other hand, what will happen when the supply changes? Right? When the money supply increases, of course, we have seen, right, the equilibrium interest rate falls. Clear? Right. So up to now, we have seen 2 theories. One is portfolio choice, other one is liquidity preference framework. These 2 theories tell you how an interest rate is determined. Where the portfolio choice is based on the bond market, the interest rate is decided, right? So Keynes says alternatively, you can take the market for money and also you can arrive the interest rate, right? Okay, so now we know how interest rate determined. Here I have given some text. I also will explain to you all the relationship between money and the interest rate. According to our discussion, the liquid preference analysis seems to lead to a conclusion that an increase in money supply will lower interest rate. That's clear, right? Yes. This conclusion has important policy implication because it has frequently caused politicians to call for a more rapid growth of the money supply in an effort to drive down interest rate, right? This is what happens, right? You can think of any country's situations everywhere, like politicians try to bring down the interest rate. So then they pressurize central bank to, issue or increase the money supply, right? That we have seen. But the Milton Friedman, he also Nobel laureate in economics, he said, this is okay, this happens, but if other factors also move, this may not be happen as well, right? He says, I don't want to get into that because like already we discussed so many things outside the area, but you also can think, because we here say, okay, everything else is equal, the others are constant, right? But if you remove that condition, right, so then even other way around also happen, right? That's what economics all about. Clear? If you have any doubts, interrupt me and ask, okay? And further, an increasing money supply is an expansionary influence on the economy. Now, these are the wording. Most of things you should know the wordings or like phrases we used in economics. We call it expansionary monetary policy. What is that? If anybody can tell me. Okay. Chaminda, have you gone through the press release of central bank?
I'm not clear, sir.
Okay. Okay, let me tell you. Now, central bank very often, like central bank job, I don't know whether, yeah, we have discussed earlier. The central bank objectives are, one is economic and price stability. Price stability, right? Okay, we discussed. And central bank always do the research, evaluate, and see the factors that influence the price stability, and always want to have stable price. So every time central bank discuss, and after discussions, they issue a press release, explain the situation of the overall situation of the economy, and say whether they are going to increase the rate or reduce the rate, or what will be the changes, interest rate, right? Have you all seen that press release? If you all haven't seen that, please download, one paper is enough, latest one, and see. Right? In central bank, so many mechanisms are there. There's a department called Economic Research Department. They do the researches. They discuss. There's a committee called Monetary Policy Consultative Committee. They discuss there, right? And finally, we will arrive into a conclusion whether to increase rates or decrease rates, or what will be the shape of the economy. They will explain to you. That will be given as a press release as well. So in that press release, just go and read that. So many, economic jargons will be there. One of the jargon is expansionary monetary policy. What is that? So expansionary monetary policy means you are going to, right, expand your money supply or increase your money supply to stimulate your economy, further consumption, so that stimulate the economic activities. You will have an expansionary monetary policy. That's what here says. Sorry. An increased money supply and an expansionary influence on the economy. It should raise national income. As I said, more money supply, consumption stimulated. So national income means GDP. It should increase national income and wealth. Sorry. Both the liquidity preference and bond supply and demand frameworks indicate that interest rate will then rise. Right? So if you come to income effect is a rise in interest rate in response to the higher level of income. That means a one-time increase in the money supply will cause prices to rise to a permanently higher level by the end of the year. The interest rate will rise via the increased prices. You can, apply this statement even now Sri Lankan current economy. Right? So price level effect remains even after prices have stopped rising. A rising price level will raise interest rate because people will expect inflation to be higher over the course of the year. When the price level stops rising, expectation of inflation will return to zero. Right? Expected inflation effect persists only as long as price level continues to rise. Keep this in mind. These are the summary of our discussion, right? I don't think further elaboration needed for that. There are few, additional points you could see. So you will get, after this discussion, you will get, okay, does a higher rate of growth of money supply lower interest rate? This is the question always we used to have. But in practical sense, this can go any way, right? Any other ways, right? So if you go with this each and every explanation, so 4 factors I have given here. If you take this liquidity preference framework, lead to a conclusion that increase in money supply will lower interest rate. That's a liquidity effect, right? So if you come to income effect, that says interest rate rising because increase in the money supply is an expansionary influence on the economy. Income effect. And then price level effect. That predicts an increase in the money supply leads to a rise in the interest rate in response to the rise in the price level. Right? Same thing. The expected inflation that shows increase in the interest rate because an increase in the money supply may lead people to expect a higher price level in the future, right? That is expected inflation effect. So I think you may be clear on this summary, right? So if you don't understand, even just go through again, and please let me know in the next class if you don't understand this. The summary especially. Right? You can recall the previous slides and see whether everything is in line. So here you can see the relationship between money growth and interest rate. Now you see the green, the blue color is the money growth rate. We have taken, or the book has taken M2. That's more relevant to US economy. M2. This is a money growth or money supply growth. And then interest rate is the 3-month treasury bill rate. How that goes, you can see. The relationship between money supply and interest rate. Clear? Now you can see we couldn't establish a clear correlation between these two, right? So even though we studied, right, when the money supply increases, what will happen? interest rate will come down. That's what we see. That is the liquidity effect. But if you couple with other effect, income effect, price level effect, and expected inflation effect, the relationship may be totally wrong. Now you see that a part of 2010, the money supply increases, but interest rate is very low. This is after the financial crisis, right? Even though you increase the money supply, interest rate is, right, very low at this time, right? Here, but before 2010, the money supply is very low, but still the interest rate is low. Here, money supply increases, interest rate also increases. You don't see it a clear relationship because, like, not only liquidity preference frameworks works here, but also income effect, price level effect, and expected inflation, all are influencing this one. That's what you don't see a clear-cut movements or correlations or relationship among money supply and interest rate. Is that clear? I hope, I don't know, you maybe, this is the postgraduate diploma course, right? Even though we call it diploma course, right? I just wanted to give more than that, right? Or kind of master level we can think of, right? For your knowledge, because all are bankers. If somebody is from not banking sector, okay, maybe a little bit difficult to understand. But here I think you can see the broader picture. Is that okay, Gavin? Is that okay?
Yes, sir. It was all.
All right, thanks. Raja Karuna, is that okay? Is there any question out of our discussion?
It's okay. It's
All right, thank you.
very well understood. Yeah.
Now, in overall aspect, the second part, we talk about determination of interest rate. We discuss with two theories. One is portfolio choice. Second one is liquidity preference theory, right? So in that, so many analysis we have done in the portfolio choice, okay, how bond market works, and then how interest rate determine. And liquidity preference, how market for money works, and how interest rate is determined. And something changes on the supply and bond, supply and demand for bond, or supply and demand for money, how interest rate changes when other factors constant. Then finally we see, okay, we relax other factors as well. What will happen? If you relax other factors, you don't see this clear-cut relationship. That's what I saw through this graph, right? US graph, you can see if you put it in a real life, you don't see it. I hope up to now very clear. This interest rate, I'm just giving you in a full scale discussion, because that's the base everywhere, anywhere if you go, you should be able to think of, right? Even though this is allocated for one lecture, it's maybe more than 2 lectures we are discussing, right? Still, the last part is there to be discussed. I think next class also I'll be continuing, right? But anyway, the third part, now you know, you understood interest rate, and then you know how interest rate behaves. But every time when central bank doing something, when your bank's doing something, you see what's happening to the interest rate, right? That is your price, right? Always, right? So think how interest rate behaves. A third part, I want to bring in the risk structure and the term structure of the interest rate. Up to now, we discuss, okay, it's kind of plain vanilla. Now, if you are going to bring this risk and term structure of interest rate, we should be able to understand, right, how interest rate behaves. Under that, we'll be seeing risk and term, and then three theories, that is expectation theory, segmented market theory, liquid premium, and preferred habitat theory, right? The theories are very important because it's after so many analysis researchers, you know, with the different countries' data, especially US data, they arrive into a conclusion, okay, this works like this, right? So, but now maybe the economic structure, the complexities change, as I said earlier. But still, if you keep everything else constant, then this is applicable. The changes, right? Okay, so next, okay, first I'm going to like discuss risk structure of the interest rate. Before that, we should understand the bonds with the same maturity have different interest rates, right? The bond with the same maturity have different interest rates, right? Have you seen that? Okay, you can take it 3 months treasury bills. You can take it 3 months commercial paper, right? You can take it some other investment, 3 month maturing investments. If you take together and see, the interest rates are different. What are those reasons? If you take, okay, Sri Lankan treasury bill, 3 months treasury bills. And if you take, okay, Indian treasury bill, 3 months. Or US treasury bills for 3 months. Interest rates are different. I just want to stick into the US market, right? And tell you. And you can replicate those into our Sri Lankan market as well. The reason behind those interest rate differences is, one is default risk. Second, liquidity. Third, tax considerations, right? Let's see now here in this chart, you can see 4 types of bonds and see the yield. The y-axis, this annual yield, and these are the years. Right? See. Now, if you see the yield, corporate BAA bond, it's a blue color, high interest. Right? And then you can see the red one, corporate AAA bonds. And third, you can see US government long-term bonds. And fourth, you can see state and local government, that means municipal government bonds. They call it municipal bonds. If you see the same maturities, but if you see the yield rate, annual yield rate, it's all different. But it moves together, that's a different story. But different interest rates. Now, if you take this 1930, the corporate BAA bond is 12%, and then red color is the corporate AAA bond is maybe 5.7%, and then the US government long-term bond may be lesser than that, but still municipal is more than that, so it changes, right? If you take after 2010 even, right, it may be similar to that, right? Okay, why we have seen, even though the same maturity bonds, the default risk may be different, liquidity may be different, liquidity characteristic, and there may be some tax consideration. Sri Lanka also you can think of. Is that clear? Are you all with me? Now what we are looking at is why this differs, why this interest. We say, okay, market determined, bond market determines, and then market for money determines, but still there are some other aspect to look into that. That's one is risk, right? Okay, so then first is risk, that is default risk. The default risk means probability that the issuer of the bond is unable to or willing to make interest payment or pay off the face value. What is the default risk? Is that clear? It's as usual. In your bank, you say default risk. That's a credit risk you are talking about. If it's a lending portfolio, right? So you are giving credit and customer failed to pay back, that's a credit risk. So something like that. In a bond, right? Issuer failed to honor that, so then that's a default. But we can say US Treasury bonds are considered default free. What about Sri Lanka? Sri Lankan Treasury bonds or Treasury bills. Is it default free?
Yes.
Why? Why you're saying like that?
Because it's like government securities. Somehow the government makes sure that we get back up in.
How you can make sure? Okay, let's put it together. The treasury bill also government securities. So sovereign bond also government securities. Is it default free? Both are default free. Come on, Dilusha.
It's default free since government has the authority to print money.
Okay, so then what is the direct answer to my question? You have treasury bills and sovereign bonds. So both are, government can print money. So both are default free. Is that so?
Yes.
Why these so many stories then Sri Lankan government is going to default their sovereign bond?
That depends on the country's rating.
That depends on the country's rating. So why we are saying then sovereign bond, the Sri Lanka is going to like they are suspecting.
No, if the country's ratings are going down, the demand for bonds will be lower in the international market.
Yes, I got your answer, but still I have the questions. Okay, but nobody is talking about the treasury bill default. Even the rating coming down.
Those are short-term ones.
Okay, treasury bond. Even nobody is talking about treasury bond. Visista?
Treasury bill and bonds, Sri Lankan rupee.
Okay.
Uh,
You are very
so,
close to the answer.
Foreign currency deficit and all, if we are having sovereign bond is risky.
Okay, now straight to the answer. Now, why default free Sri Lanka treasury bills and bonds? Because government can pay back by printing money. You can print rupee, right? You can print money and you can pay back if government wants. But the sovereign bond is a dollar bond. You cannot print dollar. So that's what when it comes to bonds of the government, if it is a sovereign bond or dollar bond, then people are talking about default risk. But nobody is going to talk about treasury bills default risk or treasury bonds default risk, because as and when due, government can print money and settle. Treasury, if a Federal Reserve, US Treasury issue their bonds, even that is default risk free, because the central bank of US can print USD and settle. That's what the people sometimes they don't understand now. US currency is a reserve currency, right? That's a hard currency. They can print and they can use anywhere in the world for anything, but we cannot do that. This is not the reserve currency. We can print for our local purpose only. So local debt, yes, of course, treasury bills or bonds. In the sense, when I say local, it doesn't mean like the buyers of the local buyers. I'm just telling the issue, right? Treasury bills and bonds, of course, default risk is free because can print and settle. Okay, now similar to US Treasury bonds are considered default free because government can print and settle. There are so many conditions in US, right? So printing money is not so easy. They should have all these, conditions to be met. That's what within bracket it says government can raise taxes, right? Raise the income, and through that they could do that. Here, okay, when I say risk premium, what is mean by risk premium? Okay, before we get into the risk structure, we should know what is default risk and what is risk premium. If anybody can explain what is risk premium? Okay, now risk premium, we usually use it in the banks as well. Now, if you see, like if you are going to give a loan to a John Keels, that may be 5%. And if you are going to give it to an individual, that may be 7%. The 2% is the risk premium for that individual, because the individual carries additional risk compared to John Keels. So risk premium, you are going to compare two instruments and assess the risk, and based on the additional risk, you are going to increase your interest. That is the risk premium. Now, in this case, the default risk free for what? the government securities. So government securities are subject to like default risk free. They don't have default risk, right? So if you are going to buy another bond, corporate bond, the default risk is there. So what is the risk you are taking? So between these two rates are the risk premium. Now government bond, of course, let's assume 5%. And if you are going to buy it from John Keels, that's 7%. If you are going to give or ready to give, that means the 2% is the risk premium for that John Keels. Because for John Keels compared to government, you have the default risk element. You got it? So that is risk premium, right? Now you know when it comes to risk structure of interest rate, you should think about the risk and risk premium as well. Clear? This is explained here. So now we know based on the risk structure changes, interest rate will change. Up to now, we were discussing the determination of interest rate, and then due to the risk structure of the financial assets, a risk premium will change. You should understand the next level. Now here we have given two bonds. The A is, first one is corporate bond market, and B is the default free US Treasury bond market. Right? The first, you can see the first step, an increase in the default risk. So let's assume the default risk increases. Shift the demand curve for corporate bonds left. Okay. So now if you see, okay, John Keels risk increased, then you don't buy. That means demand come down. Then price will come down automatically from VC1 to VC2. Similarly, right? So if you see, people move from corporate bonds to government bond because corporate bonds are now risky. So then government bonds demand will increase. That means from DT1 to DT2. This will happen simultaneously. That's what it's given together, because you just withdraw from your corporate bond investment and make the investment on government securities. So the government price will go up, the bonds price will go up from PT1 to PT2. So now if you see the IT2 to IC2, these are the risk premium. The step 3, which raises the price of treasury bonds and lowers the price of corporate bonds, and therefore lower the interest rate on treasury bonds and raises the interest rate on corporate bonds, thereby increasing the spread between the interest rates on corporate versus treasury bonds. Right? Okay. When the price increases, government bond, right, you will have this interest rate IT2, and then you will have the price. That means IT2 to IC2. These would be the risk premium. Is it okay? You should think, okay, when a corporate bond default risk increases, the corporate bond demand will come down. Same time, the come down means people, they're reluctant to invest on corporate bond, and then they will invest on government bond. So then corporate bonds demand will come down. Same time, right? Government demand will go up. Right? When the government treasury bonds or bills demand go up, then price will increase. When the price increases, the interest rate of the government bond will come down further. Similarly, when the price decreases for corporate bond, interest rate will go down, go up further. So then you will have more risk premium in between. Is that okay? Chaminder, is that okay?
Yes, sir. Yes.
Okay, okay, thank you. Sometimes, okay, I think today we can conclude this and continue from next class, but I just want to leave this in a very simple interest rate analysis. That's what I just covered. You know, it may be more than, you know, for diploma, maybe more, but I don't want to exclude this one, because wherever you go, whatever you do, this will be there always, right? I just want to cover everything under interest rate. Then we can, you know, based on the time, we can adjust other areas. But keep in mind, there may be a little bit confusion around when you see so many things coming into your mind. Always remember the word. What is that? Others are constant. Everything else is constant. Ceteris paribus, right? Others fixed, other factors fixed, and take only relevant variable and look into that. You don't get any confusion. This is a lot of people missed always, because when you think like without, you know, realizing that, you go into those kind of details. Okay, so if there's no more questions, I'll conclude this class and see you in the next one. Thank you so much.